The ASX 200 has now fallen for 8 consecutive sessions, but the benchmark index barely budged on each individual day. The cumulative damage, a drift toward a 3-week low, is the story, not any single session. The pressure trace leads directly to the Strait of Hormuz. Iran and the United States are 9 weeks into an active conflict, and oil tankers have slowed to a crawl. Brent crude crossed $108 per barrel overnight. West Texas Intermediate is knocking on 97. Either number would be alarming in isolation. Together, they are forcing a rethink on global inflation. The Federal Open Market Committee meets Tuesday and Wednesday this week. The outcome is not in question. Rates stay unchanged. What the market is actually reading for is tone. MFS Investment Management has flagged that an emerging minority view inside the Fed believes rate hikes may eventually be needed to protect the inflation side of the dual mandate. Chair Powell is expected to deflect that question, but the fact that it is being asked at all has shifted market positioning. That linkage, oil to inflation to rate hike risk, is what has kept buyers off the ASX for 8 straight days. Australia imports approximately 90% of its refined fuel. Higher oil prices feed directly into domestic CPI, which feeds directly into Reserve Bank of Australia expectations. Australia's quarterly inflation data is due Wednesday morning. If it surprises to the upside, the calculus on the RBA's rate path changes fast. The irony is that the ASX has not collapsed. Daily losses have been modest, but the consistency of the selling, no bid returning, no bounce, signals that institutional money is choosing to wait rather than step in. Light trading volumes have amplified the effect. Every day without a catalyst for buying registers as a new low.
The Iran conflict connects directly to the ASX's worst single stock story this week, and it is not a miner or a bank. It is an energy company that spent last week as one of the market's strongest performers. Origin Energy fell another 4% on Tuesday, after losing 6% on Monday. The trigger was a March quarter update that revealed problems on 3 fronts simultaneously. Its integrated gas segment generated $247 million less revenue than the prior quarter, driven by lower LNG prices and an appreciating Australian dollar. Its energy markets gas volumes fell 32%, largely on lower trading and power generation demand. And its UK-based Octopus Energy joint venture had its full-year EBITDA guidance cut to a range of negative $70 million to positive $30 million, down from a $0 to $150 million range. The energy company obligation scheme changes and adverse weather across Britain in February and March were the cited causes. UBS responded by trimming its price target on Origin and cutting earnings estimates by up to 18%. Origin CEO Frank Calabria noted that the Middle East conflict's lagged effect on LNG export contract pricing will not flow through to results until FY27. That admission essentially tells the market that the current pain is not yet the bottom, that future quarters carry embedded headwinds already locked in by the oil price spike. The sell-off in Origin dragged Beach Energy down 2.5% in the same session. Beach had already cut its own full-year production guidance, citing weather disruptions and ramp-up issues at the Waitsia gas plant. 2 energy companies flagging guidance misses on the same day, against the backdrop of an oil price already above 108, is a signal about the cost side of Australian energy production, not just the revenue side. Weather disruptions and operational challenges are compressing margins even as global oil prices rise. The link back to the FOMC is direct. Higher oil prices that should theoretically benefit energy producers are instead exposing the operational fragility of Australian producers locked into contracts priced below spot.
While energy stocks faced operational turbulence and the broader market drifted lower, the ASX healthcare sector was dealing with a different kind of pressure, one that had been building for 12 months and showed no sign of stabilizing on Tuesday. CSL fell to a 9-year low, touching $128.48, down 47% from this time last year. The proximate cause is specific. The U.S. military's decision to scrap its annual influenza vaccination requirement for service members removed a guaranteed demand stream from one of CSL's revenue channels. But the stock's decline predates that announcement. It reflects a broader sector-wide repositioning. Healthcare shares on the ASX are down 36% over the past 12 months. Investors have rotated away from healthcare and into energy stocks, resources, and gold, assets that perform better in an inflationary, geopolitically volatile environment. CSL's core business, plasma therapies through its Behring division, remains intact. Analysts still carry an average 12-month price target implying significant upside, with 12 of 18 analysts holding buy or strong buy ratings. But confidence has eroded through a series of compounding events. slower earnings growth, an unexpected restructure, and a CEO departure. The vaccine mandate cancellation was the most recent shock in a sequence, not a standalone event. The mirror image of healthcare's decline is visible in gold. ASX gold stocks broadly held their ground on a day when 3/4 of the index was lower. Greatland Resources delivered a standout March quarter, $1.2 billion in cash, 82,723 ounces produced, at an all-in sustaining cost of $2,056 per ounce, yet its shares dipped 2% on profit-taking after a 42% run in a single month. Moelis flagged 49% upside in Alkane Resources and 44% in Black Cat Syndicate. Gold at $4,680 per ounce creates a different operating context than any previous cycle for ASX producers. The thread connecting all three stories, the FOMC's reluctant to move, Origin's LNG exposure to Middle East volatility, and CSL's rotation out, is the same underlying force. When oil anchors above $100, capital does not sit still. It moves from rate-sensitive and growth-sensitive assets toward hard assets. The question is whether that rotation has further to run or whether it is already priced. The weight of evidence suggests the rotation continues, but only if Brent holds above $100 and Australian inflation data Wednesday prints above consensus. If the CPI number surprises to the downside, if the pass-through from oil has been slower than expected, the trade reverses fast. Beaten-down healthcare names like CSL and Medicus become re-entry points. Banks, which have already lagged the index by roughly 2% this week, would likely recover first given their sensitivity to rate expectations. Macquarie is the name analysts are pointing to as the bank-adjacent trade that benefits most from sustained market volatility. The verification benchmark is Wednesday morning's inflation print, and any shift in Powell's language around rate hike probability at the Wednesday FOMC Plus conference. If both confirm the inflation pressure narrative, the ASX's losing streak has not found its floor yet.